equity is important, but not always the greatest source of funds because it's simply not liquid or usable. Could it be better to have your equity in a form that you can actually control, cash, instead of relying on uncontrollable factors like changing home prices and unexpected expenses? If you think about your finances as 3 buckets, let's look first at monthly income bucket number 1, your ability to make money, commissions, wages, salaries, and so on. Bucket 2 is the money that you put aside for the future, your nest egg. And bucket 3 is the money that you are depositing into your house, which turns into home equity. Now, home equity is good to have in retirement and you can be proud of it, but quite frankly, cash is way better. During our earning years, we take money from bucket 1, our monthly income, and we put it into bucket 2. Sometimes we try to save 5% or 10% or maybe even as much as 20%. And that's our retirement nest egg, the money we're putting away for the future. But most of us put even more money, a lot of our income, into bucket 3 in the form of house payments, purchasing the home, making payments, improving it, all kinds of money that gets dumped into bucket 3 and it turns into equity. Quite frankly, unusable equity. Now, meanwhile, bucket 1 usually decreases and we only get Social Security or maybe some pension income, and it's usually quite a bit less than when we were working. And even with these changes, most people continue to put money into bucket 3. About 44% of the population still makes a house payment after they turn 62 and they're in retirement. And they don't necessarily need to. With a reverse mortgage loan, you can take cash out of bucket 3 instead of putting it in to provide cash flow that is not taxable as income. Now, we get it. This is a huge mental shift. But retirement is a different game and has different rules than while you were earning money. From taxes to home equity to long-term care issues, it's very different from what happened during your earning years. The better you understand these rules now, the better your retirement income can be. There's been solid research done by places like Texas Tech and Boston College for Retirement Research that demonstrate very clearly that by combining bucket 2 and 3 in your planning in your retirement funds will give you more cash flow and be far more likely to outlast you if you synergize those 2 buckets together. So reverse mortgage rules can end up working very well for you in retirement. They have no monthly repayment requirements, so you can pull money out and you don't have to put it back in. There's no risk of foreclosure at all, as long as you live in the home as your primary residence and, of course, follow the rules of paying homeowners insurance and property taxes and maintaining the home, just like you would with a traditional mortgage. Or, of course, if you had no mortgage at all. Think about that for a minute. Income tax-free distributions and have no risk of foreclosure from missing monthly mortgage payments, then the old rule of having a paid-off home in order to be secure in retirement, quite frankly, may no longer be at all the best option. We like to say, why don't you make memories, not mortgage payments?